If you haven't heard of Movement Mortgage, we are a top 10 independent mortgage bank doing over $20 billion in mortgages a year, even though we've only been in business for 15 years. Our company is very unique because we're an impact lender, meaning that we give away a portion of our profits to charities and the schools that we manage to educate many children who are future leaders. To date, we've given away over $300 million. We want to work with you to not only make a difference through our charities, but also to increase your business and help your clients. We know that in a strange way, we are actually your largest competitor because the average mortgage payment takes about 1/3 of your client's income. And as far as retirement goes, the people who are over 62 in this country hold a little over $11 trillion in home equity. This is a huge asset class that should not be ignored in any financial plan. The problem is that many of those entering retirement are still making a mortgage payment, and the majority have hundreds of thousands of dollars in equity that cannot be used for income, insurance, or investments. This huge accumulation of home equity is in one sense a very good thing. It's created a lot of wealth, but has created a retirement problem, as most people have not properly saved money with their financial advisor for retirement because they put so much into their home. As you know, more than 50% of people do not have anywhere near enough money to survive a 10-year retirement, let alone a 30-year retirement. Complicating matters further, the vast majority of your clients do not have long-term care insurance. And more than 80% of your clients are not living in a house that will allow them to age in place if they would have a major health crisis. When a reverse mortgage is done early in retirement, the traditional mortgage is purposely not paid to zero before retirement, so that more money can be put in retirement plans that you manage earlier in life. Three things will happen when housing wealth is put into the plan and the mortgage is reversed at 62 years old. First, cash flow can go up, income taxes will typically go down, and net worth and legacy to the next generation increases. Quite frankly, this disagrees with conventional wisdom, but the mathematical evidence is overwhelming. We want to be very clear that we're not asking you to start selling mortgages or to just send us your clients. We've tested this process with financial advisors for the last 8 years. We have found that when we collaborate on test cases with financial advisors, we have the ability to improve a client's overall financial wellness when reverse mortgages are factored into retirement planning. We understand that a majority of your clients do not need a reverse mortgage and that many of your clients have their house completely paid off. Those are exactly the clients that can benefit most from the research that's been done in just the last few years. I'd like to leave you with this final thought. Jamie Hopkins wrote an article a few years ago in Investment News, and I quote, "Despite some substantial improvement over the past few years, the majority of financial services professionals still fail to incorporate home equity planning or reverse mortgages into their practices. And yes, this is a failure. In my opinion, Jamie's opinion, not including home equity with a reverse mortgage in the financial planning process is the largest failure of the financial services profession at this time. It would make sense to be in touch with us at reverserequest@movement.com to set up a 1-hour Zoom call with our team, discuss this life-changing research, and look at mortgages as new and exciting planning tools. I guarantee you 1 hour will be worth your time, even if you can change the lives of just one client who is relying on you to help give them a better retirement.